December 24, 1979. The trading floor is empty. The world is asleep, wrapped in the quiet of Christmas Eve. And that is precisely when they chose to change the rules. What if I told you the single biggest rally in the history of a commodity, a rally that threatened to break the global financial system, was not stopped by the free market, not by a natural crash, but by a rulebook quietly, deliberately rewritten in the dead of a holiday night? This is not a conspiracy theory. This is financial history. This is the story of the Hunt brothers, their audacious bet against the entire monetary system, and the Christmas trap, a coordinated, three-pronged attack designed to make sure silver would never, ever hit $100. Welcome to Finance Historian Time. If you're not subscribed, you're missing the hidden patterns, the power plays, and the moments where the so-called free market gets a helping hand from the architects of the system. Don't just watch history, understand the forces that wrote it. Click that subscribe button. Let's pull back the curtain. To understand the sophistication of the trap, we must first understand the sheer scale of the prey. We have to go back to the last time two men looked at a mountain of paper money and said, "We choose real money instead." The stage is the late 1970s. Inflation isn't a statistic. It's a thief. It's stealing the value of every dollar in your pocket. Interest rates are headed for 20%. The world is losing faith in paper. Into this chaos step the Hunt brothers, Nelson Bunker and Lamar, Texan oil billionaires who saw the world with terrifying clarity. Their thesis was simple, ancient, and brutal. The government is printing money. Therefore, money is becoming worthless. Silver is not just a commodity. For thousands of years, it was money itself. So, they didn't just invest in silver. They declared a financial war of attrition. This is critical. They didn't just buy paper futures contracts and wait. They embarked on a physical conquest. They bought, and they bought, and they bought. They took delivery. They warehoused it. At their peak, they controlled over 100 million ounces of physical silver. To put that in perspective, that was more than the entire annual production of every silver mine on Earth. They weren't betting on a price. They were building a corner. And then, the market woke up. The price began to move. From $6 to $15, then $20, then $30. By January 1980, it hit $50 an ounce. Panic is not a strong enough word for the banks and brokerages on the other side of these trades. This was an existential threat. Every dollar up meant billions in losses for them. The free market was screaming one price, but the system that was built on paper promises couldn't afford to listen. This little bar was about to break the biggest banks in the world. And when you threaten the system doesn't play fair. It rewrites the game. Phase 1 of the trap wasn't a headline. It was a footnote, buried in a holiday memo. The first weapon was bureaucracy. In the days leading up to and just after Christmas 1979, the COMEX and the Chicago Board of Trade enacted a series of new volatility-based margin requirements. Let's break this down. A margin is the good faith deposit you put down to control a large contract. Normally, it's a fixed percentage, but a volatility-based margin is a moving target. As the price swings get wilder as they were doing daily, the exchange can arbitrarily increase the cash you must post, overnight, with little warning. This wasn't risk management. This was a liquidity siege. It was a direct, surgical attack on the Hunt's greatest weakness, cash flow. They owned billions in asset silver, but they now needed billions in liquid cash to meet these spiraling margin calls. The system was using its own rulebook to force a liquidity crisis on its biggest player. The trap sprung on March 27, 1980, Silver Thursday. The price collapsed. The Hunts faced a margin call of $1.7 billion in a single day. They couldn't pay. Default, a chain reaction of bankruptcies through Wall Street, was imminent. And here is where the free market officially ended. A consortium of banks, with the explicit blessing and orchestration of the Federal Reserve, extended the Hunts a $1.1 billion loan. This is the masterstroke. It looked like a rescue. It was, in fact, a negotiated surrender. The loan's conditions: the Hunts had to agree to never speculate in commodities again and to liquidate their entire silver position in an orderly fashion, meaning they had to sell into a falling market on the system's terms. Let that sink in. The central bank facilitated a loan not to save the speculators, but to save the brokers who were exposed to them. They didn't prop up the price, they guaranteed its controlled demolition. The Hunts were neutered. The corner was broken. But the architects needed one more Tula permanent kill switch for the future, the final piece of the trap, the ultimate weapon of mass destruction in the financial system's arsenal. It's called COMEX Rule 7, Emergency Actions. Rule 7 states that in an emergency, a term they get to define, the exchange can take any action necessary to restore orderly trading. Let me draw what that means for you. They can limit trading to liquidation only. You can only sell. You cannot buy. They can force settle all contracts at a fixed price they dictate, regardless of what the market says. They can shut it all down. This is the nuclear option established in the wake of the hunts. It is the permanent, standing threat to any future corner. And this team is not ancient history. The DNA of the Christmas trap is coded into every modern market break. The 2021 meme stock saga. Same playbook, increased margin requirements. Check. Limiting trading. Check. They literally turned off the buy button. The looming threat of more drastic, Rule 7 style action to protect the market. Absolute check. The ghost of $100 silver haunts every single speculative surge. It's the ultimate lesson. In a battle between physical reality and the paper market holds the rulebook, the judge, and the emergency button. Can silver, or any asset, ever truly moon within this system? To do so, it must break the physical chains of the exchange itself. Otherwise, Rule 7 is the final boss level. So, what is the historian's lesson from the Christmas trap? It's not that corners can't happen. They can. It's that when they do, and when they threaten the underlying architecture of the financial system, the response will not be determined by free market principles. The response will be regulatory, operational, and political. It will be margin hikes over holidays. It will be backroom loans with strings attached. It will be the looming specter of Rule 7. The goal is not to find a price, but to preserve the system. For us, the investors, the speculators, the students of history, the lesson is this: understand the structure of the game you're in. Read the rulebook. Know where the emergency exits are and who controls them. The stated rules are the easy part. The emergency powers are the real leash on price discovery. This has been Finance Historian Time. We dig into the moments where power, finance, and human ambition collide to write the history we all live in. If this deep dive changes how you see market crash, squeezes, and the very concept of a free market, then you're starting to see the matrix. Do me a favor. If you learned something today, smash that like button. It genuinely helps the channel. If you want to join us as we dissect more of these hidden turning points from the London gold pool to the 1995 bond market bailout, then make sure you are part of the community. Subscribe to Finance Historian Time and ring the notification bell so you never miss a story. Now, I want to hear from you. In the comments, tell me, where do you see the next Rule 7 moment being tested? Is it in another commodity like nickel or uranium? In the treasury market itself? Let's get a conversation going. Until next time, stay curious, and remember, history doesn't repeat itself, but it often rhymes. See you in the next chapter.